Everyone watching ARM is asking the same thing right now. The stock surged 15.7% on the day, sparking FOMO. But does the rally have substance? ARM9 delivers a 2x boost in vector compute per watt. That gain slashes AI inference latency by half, reshaping revenue forecasts. The lab ran the numbers. Lab score, 66 out of 100 by. ARM's dominance is now cemented by a sub-100-watt TDP, thermal design power, the maximum heat a chip generates that a cooling system must dissipate, which makes x86 architectures look like legacy space heaters in the AI data center. While Wall Street focuses on licensing fees, the engineering reality is the transition to the 3nm N3E process node, TSMC's second-generation 3nm manufacturing technique that optimizes power and yield. This move to N3E allows ARM to cram more transistors into a smaller die size, the physical area of the silicon chip measured in square millimeters, without hitting the thermal wall. By integrating the ARM 9.2 instruction set into NVIDIA's Grace Blackwell superchip, they are achieving 900 GB per second of bidirectional interconnect bandwidth, the speed at which data travels between the CPU and GPU. This interconnect speed is the death knell for traditional PC-based Peripheral Component Interconnect Express, the standard interface for connecting high-speed components, bottlenecks found in Intel or AMD systems. The lab tracks the shift from general-purpose compute to domain-specific silicon, where ARM's architectural license allows partners to strip away the cruft of legacy x86 support. This reduces silicon area and lowers power consumption per token generated. With the RSI, Relative Strength Index, a momentum indicator measuring the speed and change of price movements, hitting 84.9, the market is finally pricing in the structural shift from ARM being a smartphone play to becoming the mandatory backbone of the $437 billion AI infrastructure layer. Today's 15.7% surge isn't hype. It is the financial realization of ARM's superior joules per instruction efficiency. Quarterly financials showing modest revenue momentum for ARM. By Q4 2026, the normalization of the yield curve, the spread between long-term and short-term interest rates, will drive a 20% expansion in ARM's royalty revenue as hyperscale capex, capital expenditures for infrastructure, shifts from emergency hardware stockpiling to architectural efficiency. With the Fed rate at 3.63% and CPI, the Consumer Price Index measuring inflation, at a cool 0.6%, the cost of capital is finally predictable. This stability allows ARM's partners to commit to long-term architectural shifts despite a 4.3% unemployment rate, signaling a softening labor market. However, the macro tailwind faces a massive friction point, the looming threat of universal tariffs. As trade war rhetoric escalates over Greenland and global trade routes, ARM's 20.1% revenue growth is being stress-tested by a policy environment that favors domestic manufacturing over the globalized IP, intellectual property, licensing model that ARM dominates. The geopolitical landscape is shifting from tactical skirmishes to structural warfare. While the market ignores the 7.3% recession risk, the real danger lies in the erosion of Fed independence, the central bank's ability to set monetary policy without political interference. This uncertainty, combined with renewed trade war fears, creates a volatile backdrop for ARM's 3.41 beta, a measure of a stock's volatility relative to the broader market. As the US-China tech war intensifies, any disruption to the Taiwan-based supply chain directly threatens ARM's EPS, earnings per share, growth of 47.9%, as their silicon partners rely on those specific geographic choke points. We are seeing a social pivot where AI regulation is no longer a fringe concern but a central election theme. With a 13.3% short float, the percentage of shares held by investors betting on a price drop, any positive policy shift will trigger a massive squeeze. The macro reality is clear. Trade barriers are the only thing standing between ARM and total data center dominance. ARM reported earnings per share of $0.60, beating the Wall Street estimate of $0.59 by 2.1%, a solid beat that signals strong execution. ARM is trending higher, currently at $408.85. ARM just hit a record high on headlines screaming NVIDIA's ARM-based chips power the AI PC revolution. But let's read the room. Management's script is polished. AI demand is structural. Our architecture is the foundation, and we're diversifying beyond mobile. That's the official narrative, clean, repeatable, and designed for CNBC soundbites. Yet insiders just dumped 280,843 shares in the last 90 days. That's not a rounding error. That's a pattern. When executives sell at a 14% pop, it's not about cashing out for a yacht. It's about risk they see coming that the street hasn't priced yet. Historically, this volume of insider selling precedes margin compression or a guidance cut within 2 quarters. They're not selling because they're bullish. Now look at the numbers behind the PR. EPS beat by 2.1%. Fine, but the real story is R&D. $2.8 billion, 56.4% of revenue, up 34% YOY. That's not efficiency, that's desperation. When R&D grows faster than revenue, it signals the product pipeline isn't generating enough gross profit to fund itself, so they're burning cash to stay relevant. What management calls investing in the future, the lab hears. We're not winning on merit, so we're outspending the competition. And here's the 10Q risk they're not talking about. ARM's royalty model is being commoditized by RISC-V, and their diversification into data center is still 80% dependent on NVIDIA's success. Watch this inflection point. If R&D as a percentage of revenue ticks above 60% next quarter, the bull thesis is broken. The street sees a foundation. The momentum breakdown for ARM. RSI sits at 84, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above 0. The bull case rests on ARM9 architecture, the latest instruction set that doubles vector processing efficiency for AI workloads. Integration of Neoverse V3 cores into NVIDIA's GB200 NVL72 racks creates an unbreakable royalty stream. This is the fundamental compute layer for every Blackwell-based AI factory scaling globally today. The bear case starts with a trailing PE of 481.0x, the ratio of share price to per share profit. Export controls on Neoverse V-series cores force Chinese giants like Alibaba toward RISC-V, an open-source architecture bypassing licensing fees. Geopolitical friction is creating a permanent revenue ceiling in Asia that Wall Street is currently ignoring. The question no one asks: does the Snapdragon X Elite ramp translate to market share, or just channel stuffing? Channel stuffing, the practice of inflating sales figures by sending more products to distributors than they can sell. The lab's answer: Windows on ARM is the first real threat to x86, the traditional PC processor architecture, in decades. However, the RSI of 84.9, Relative Strength Index measuring overbought conditions, suggests the market has already priced in flawless execution. We are tracking the V9 royalty transition, not just unit volume. If ARM holds its position in the upper third of its 52-week range, expect a test of $423 resistance. Resistance, the price level where selling pressure outweighs buying. If hyperscaler capex, capital expenditure on data center infrastructure, cools, expect a correction toward $203.26 support. Support, the level where buying pressure prevents further declines. The lab's call: with an AI score of 66 out of 100, we anticipate high valuation consolidation until V9 royalties confirm the ramp. NVIDIA up 6.3%, lab scores 71, buy. Blackwell's FP8 tensor cores now deliver 2.5 teraflops per watt, a 45% boost over Hopper, while the 7nm node drives 30% lower power draw. That efficiency translates into a projected 12% gross margin lift for Q3. Stay tuned as we dissect die size, packaging yields, and pricing power that fuel this surge. NVIDIA's lead is currently anchored by a 10 terabytes per second, the measure of how much data moves between chips, interconnect speed that competitors physically cannot match. While Wall Street obsesses over generic AI demand, the lab is tracking the 1,200-watt TDP, thermal design power, the maximum heat a cooling system must dissipate, which is pushing data centers to the physical limit of air cooling. The B200 GPU utilizes two 800 superscript 2 dies linked via NVLink, hitting the reticle limit, the maximum physical size a lithography machine can print on a silicon wafer. This gives NVIDIA a massive bandwidth advantage over AMD's MI300X, which uses a different chiplet configuration. We are seeing a move toward architectural density that competitors cannot match without catastrophic yield losses. The real bottleneck isn't the logic, it's the CoWoS, chip-on-wafer-on-substrate, the advanced packaging that stacks memory and logic together. At a $5.4t market cap, NVIDIA's 6.26% jump today is less about software and more about the stabilization of 3 nanometer, the latest generation of transistor miniaturization, production yields at TSMC. While NVIDIA underperformed the XLK, the technology sector exchange-traded fund, by 15.9% over the last 30 days, today's price action at $224.36 signals a rotation back into the hardware layer. Investors are realizing that as models grow, the joules per token, the energy required to generate 1 unit of AI output, becomes the only metric that matters. NVIDIA's hardware stack remains the only viable solution for high-density compute at scale. Quarterly financials showing modest revenue momentum for NVIDIA. By Q4 2026, the resurgence of aggressive trade protectionism will compress NVIDIA's valuation multiple by at least 15% as the cost of global silicon logistics skyrockets. While revenue growth sits at 85.2%, the macro tide is shifting. The Federal Reserve has held the Fed rate, the interest rate at which commercial banks borrow from each other overnight, at 3.63%, but with the yield curve, the visual map of interest rates across different loan durations, finally normalizing, the era of infinite liquidity is over. Unemployment has reached 4.3%, yet the lab sees a deeper threat than a 7.3% recession risk. New tariffs are a direct tax on the complex supply chains feeding Blackwell. Every tariff hike hits the gross margin of a company currently enjoying 214.5% EPS. Earnings per share, the company's profit divided by its outstanding stock growth. Global trade is stumbling as the market digests a trade war over Greenland, reigniting fears of total supply chain decoupling. This isn't just about territory. It is about securing the rare earth elements, the group of 17 metals critical for manufacturing high-performance magnets and sensors that NVIDIA's partners require. While peers like ARM surge 15.7% on licensing news, NVIDIA faces a political stress test threatening the independence of the central bank. A shift in leadership could destabilize the 10Y yield, the interest rate on 10-year Treasury notes serving as the risk-free benchmark for global assets, currently at 4.45%. We are witnessing a collision between historic silicon demand and a geopolitical reality that seeks to balkanize the tech stack. The capital is flowing to hardware, but the gates are being locked by policy. The macro environment is the friction that will stall this rally. NVIDIA reported earnings per share of $1.87, beating the Wall Street estimate of $1.79 by 4.3%. A solid beat that signals strong execution. NVIDIA is trending higher, currently at $224.36. NVIDIA's earnings call 8K filed May 20th buried the lead in legal boilerplate, regardless of any general incorporation language in such filing. That's not filler, it's a flashing red sign. Management is preemptively widening the liability shield because they know the next 10Q will contain language that could spook auditors. Meanwhile, insiders net sold 912,357 shares in the last 90 days. Nearly 1 million shares offloaded while the stock sits at all-time highs. That's not a tax sale. That's a pattern that historically precedes margin compression or a node transition stall. Executives aren't stupid. They're selling into strength because they see the silicon ceiling before Wall Street does. The EPS beat of 4.3% looks pristine, but dig deeper. R&D spend ballooned 43.2% YOY to $18.5 billion, now 8.6% of revenue. That's not efficiency, that's desperation. NVIDIA is burning cash to stay ahead of Blackwell yield curves and CoWoS reticle limits. Every dollar of R&D above 7% of revenue is a bet against commoditization, and they're betting big. The PR spin calls this long-term leadership, but the lab hears one thing. The Hopper to Blackwell transition is costing more and delivering less than the roadmap promised. Watch the next 10Q for one line. If inventory write-downs appear under risk factors, the bull thesis fractures. That's the inflection when the cost of staying ahead becomes visible on the income statement. NVIDIA has delivered a solid 4-quarter EPS beat streak, averaging a 3% surprise. R&D spend is robust at $18.5 billion, growing 43.2% year-over-year. This heavy investment signals continued conviction in the product roadmap, but the insider selling suggests questions about future return on that investment. Management's recent 8K filing notably includes language emphasizing Securities and Exchange Commission made by the company, whether made before or after the date hereof, regardless of any general incorporation language in such filing. This isn't about market growth, it's defensive. This specific phrasing tightens the scope of liability, indicating a heightened focus on legal and compliance risk, not just revenue acceleration. What management is saying is growth and innovation. What the lab hears is managing future legal exposure while maintaining an aggressive R&D spend to stay ahead. A prudent 10Q risk factors section would likely flag increasing regulatory scrutiny and potential market saturation in specific high-end AI segments, despite broad AI demand. The critical metric to watch in the next 10Q is any material increase in specific legal provisions or a shift in the language around export controls. The momentum breakdown for NVIDIA. RSI sits at 53, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. NVIDIA is dominating the transition to the Blackwell architecture, the new silicon framework designed for massive AI scaling. The GB200 NVL72 platform integrates Grace CPUs, central processing units, and Blackwell GPUs, graphics processing units, into liquid-cooled racks. They aren't just selling chips anymore. They are selling the entire data center node. This shift captures the sovereign AI infrastructure build-out. But here is what breaks the bull thesis: thermal complexity. Shifting to liquid cooling at the rack level introduces mechanical failure points that can stall deployments. If TSMC's CoWoS, chip-on-wafer-on-substrate packaging, yields slip during this ramp, margins will compress instantly. Furthermore, Titan BS, Bureau of Industry and Security, export controls make the China revenue gap permanent. Here is the question for management. Can NVIDIA maintain its 17.7x forward P/E, price-to-earnings ratio, if Blackwell yields underperform? The lab's answer is no. While the 0.42 P/C ratio, put-to-call ratio, indicates heavy bullish sentiment, the MACD, moving average convergence divergence, shows bearish momentum. The chart is forming a rising wedge, a bearish pattern where price narrows between upward-sloping lines. This suggests the current price action is exhausting itself. If NVIDIA breaks resistance at $235.74 by next quarter, the Blackwell cycle is officially de-risked. If thermal issues delay shipments, expect a fast drop to the $196.50 support level. The lab's call. Our AI score of 71 out of 100 signals consolidation is the most likely path, confirmed only by holding the MA20, 20-day moving average, of $216.75. Today's top signal shows ARM's design when outweighs NVDA's GPU surge. Which of today's picks would you put real money on, ARM or NVIDIA? Comment your reasoning. Remember, This is not investment advice, it's educational content. Always conduct your own due diligence before committing capital, and never assume past performance predicts future results. Markets shift quickly, and individual stock risks can vary dramatically based on product cycles, supply constraints, and macro policy changes worldwide. Stay sharp, and see you in the next lab, folks.